Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another weekly market recap at the end of the week, featuring, as usual, my good friend Lance Roberts. Hey, Lance, how are you?
Fine. How are you? Ready for Thanksgiving?
Yeah, that's right. We got Thanksgiving coming up next week. Lots to be thankful for, Lance. And let me start with the ingratiating. Hugely grateful for you and being willing to come on every single week with me on this weekly market recap. We started it right at the beginning of the year. And lo and behold, here we are getting close to Thanksgiving. It's gone really well. I think feedback from folks has been really positive. The views have been great. So anyways, I thank you for committing so much of your time for this, given what a busy guy you are.
Well, it's no problem. I mean, your wife called me when you started this and said she'd pay me to be on here with you. So she was worried nobody'd show up. So yeah, it's working out fine.
That's great. Yeah, that's just like she ties a pork chop around my neck to get the dog to play with me. Yeah, I'm very used to it.
Yeah, no, it's all good. No,
all right. Well, look,
so that's great.
Lots as usual to dive into this week. We went almost 2 hours last week, and it still had a bunch of people saying we should go longer. But man, I want to try to not make it that long this time. Yeah, exactly. No. Speaking of our wives, I think they really want it to be a little bit shorter. So let's talk about the market action this week. You know, from sort of beginning to end. The markets didn't really, they closed near where they started the week. A little bit of a round trip. I'll let you get into the details of that. Let me just kick off your response with a comment that Alf Peccatiello made on today's interview with him, which is that he believes that, yes, the market could still rally from here for a bit. His bias is that the bear market is not over yet, and we'll see a lower bottom in 2023. But his point was, he's like, when I see at this point, given everything going on, the S&P between 4,000, 4,100, he's like, to me, that feels like thin air. That feels like about as far as this thing is likely going to get, given what he sees around here. Do you have a similar interpretation or a different one?
Well, so we have to go back 5 weeks ago now. So, 5 weeks ago, you and I were talking about markets were, setting a new low, super bearish, sentiment in terms of investors, super negative positioning by professionals. And we were talking 5, 6 weeks ago saying, hey, look, this is the prime setup for a reflexive rally. And we said back then that our target was 4,000, 4,100. And, here we are, right? And what's interesting is I just did Charles Payne yesterday on Fox Business, and he asked me about bullish sentiment. He's like, he says, retail investors, the AAII, the American Association of Individual Investors, their bullish sentiment's now up to 33, which is off that near record low we had it in the 20s for bullish sentiment. And he's like, well, that means, isn't that bullish? And I'm like, well, it's bullish, but it's also contrarian because nobody wanted to own stocks 5 weeks ago. Now everybody wants to buy. I mean, I'm even getting calls at the office from clients going, is it time to get all the way back in?
Right.
No, it's not. But so here's a couple of things. There are a couple of things that bother me about the market right now in terms of sentiment and what's going on, right? There's too many people calling for a recession. That's problematic. Now, I think that you and I will see those recession calls die out first part of the year. If the Atlanta Fed is even close to right, they're over 4% growth for the fourth quarter right now. So you just had a 2.6% print in quarter three. You had a 4% print in quarter four, at least at this point. So just assuming the Atlanta Fed stays where they are now, you've had 2.6 and 4.0, growth in the economy. Unemployment still is near record lows. Jobless claims really aren't ticking up very strong. Continuing claims are still some of the lowest on record. So, I think what I'm hoping for is that we get into the first part of next year and the mainstream media kind of starts going, see, there's no recession in sight. No, everything's fine.
False alarm. We dodged a bullet. Yeah.
Exactly. Soft landing, all that. And that's typically what you want to see because when everybody's looking for a recession, typically something else tends to happen. And that's an old Bob Farrell axiom, right? Bob Farrell rule number 9, when all experts agree, something else tends to happen. Yeah. So I think, next year we'll see some of these recession calls come up a bit. You'll hear things like, oh, the inverted yield curve is wrong this time because of A, B, or C reasons. And we've heard all those before. And then that's when potentially the recession will actually grab hold later next year. So the other problem that's going on is there's a lot of people, and again, I'm not saying anybody's wrong, right? I'm just saying there's a lot of calls for another leg lower in the markets. And, that's possible. I'm not saying it's not possible at all. And I think it's something that you should pay attention to. The Fed is hiking rates. And this is what I talked about with Charles Payne yesterday. The Fed is hiking rates. A lot of those rates have not come through the economy yet. Earnings have not been revised down enough to reflect for slower economic growth. And they certainly haven't come down enough to reflect for a recession. Earnings declined more than 15% in 2012 and 13. And that was just a manufacturing recession. It wasn't even an official recession. And we haven't even brought earnings down enough to encapsulate a negative growth rate yet. I mean, we don't have a negative earnings recession built into estimates yet. So, I think there's a lot of work to do on that side. And if earnings come down, then prices do have to come down. So you can't, prices can't stay where they are and earnings come down because valuations go up. So prices have to come down with earnings. So yeah, I think there's a real risk that we see another leg lower in the markets. Where that ultimate bottom is, that's debatable. We can come up with a whole variety of arguments for 3,000 to 3,300 to 36, depending on how you want to evaluate things. But I do think there's risk next year. And I think we need, once we get through the end of this year, I think this little rally we have right now has some legs through the end of the year with a bit of a breather sometime around the first 2 weeks of December. We can talk about why. But then next year, I think we've got to go through a revaluation process. Okay.
So let's talk about the potential bullish case here in the near term. And then we'll get a little bit more into the what could go wrong side of things, because you wrote a piece the other day called Hard Landing Coming, ? And basically pointing out the disconnect between investor sentiment right now and the remaining risks that are out there. So we'll do a little bull, then we'll do a little bear. Real quick though, before we do the bull, is there anything notable about what sort of pushed prices around this week at all that it's worth noting?
Well, no, I think it's a little bit of we've had a very strong run. I should actually let me restate that. We've had a nice run. I wouldn't say it was really strong. We've had a nice run. We had a
super strong couple of days.
Well, that was what I was going to say. So we had this really strong couple of days. Now, actually, this kind of market action this week is really kind of bullish. And the reason is we had this 5.5% update and we had a follow through day. That was great. And then the markets got to 4,000, which was our first kind of target. And if you draw a trend channel on this little rally up in the market, we rallied right to the top of that trend channel, which is about 4,000 on the S&P 500. And we've kind of come off of that and we're holding the 100-day moving average. So, and then just below that, the 20-day moving average is crossed above the 50-day moving average. That's bullish. That provides more support. There's a rising trend channel at the bottom that's running right along the 20-day moving average. That's additional support for the market. So this little bit of a pullback here is actually kind of healthy, consolidating some of those recent gains, distributing out some of that overbought condition that kind of got built up, and kind of giving the market some ability to have one more potential leg higher, which I think that could happen next week and the week after because of, the fact that basically the inmates will run the asylum for the next 2 weeks. All the traders are all leaving for the Hamptons this weekend. So they will be taking their private jets to the Hamptons to be hanging out for Thanksgiving. And all the retail traders on Robinhood will be buying stocks. So, that's going to be, kind of the next 2 weeks. So I think that could lift markets a little bit. First 2 weeks of December. So September sucked. If you remember in the markets in September, it was really terrible, right? Markets just went down for the entire month. That was that point where you and I were talking about super negative sentiment, negative pessimism, good setup for a rally. We had 25% of mutual funds have their year-end redemptions in September and in early October. So you had a lot of selling that occurred by mutual funds there. November only has 5% about mutual funds, having their year end. 20% of mutual funds have their year end in December. So if you go look at a chart of months of December, what you'll generally see is a bit of a sell-off in the first 2 weeks of December. And that's all those mutual funds making their annual distributions. Then as they do all that selling, to make those distributions, they've got to put that money back to work and get the portfolios rebalanced for the end of the year for their year-end reporting. And that's why you get that traditional Santa Claus rally. So I what kind of my best guess, and again, this is just a guess, anything can happen, right? But kind of our plan of action, we sold some additional exposure right around 4,000 earlier this week, raised a little bit more cash, looking for this pullback in the first couple of weeks of December, maybe add a little bit of trading exposure into year end, and then reduce equity again going into the first of the year, because that's where I think we're going to start playing catch up with some of these rate hikes. So that's the trading plan at the moment.
All right. So you talked about the bullish, potentially bullish impact, and maybe it's slightly bearish and then bullish of them selling off their losers.
I mean, you got to have
but they're basically gonna window dress, right? They're gonna sell what didn't perform well. They're gonna buy what performed well for the year to show everybody, oh, we have it in our balance sheet right now, right? And that's going to potentially, raise some share prices right there at the end. And then in conjunction with that, we also have buybacks back in play, right? So that in theory should lift at least the companies that have the cash reserves to be able to do buybacks, right?
Right. Well, yeah. Apple has bought back $584 billion worth of stuff. So
crazy.
$500 billion. Walmart just announced a $20 billion buyback after their announcement last week. So, look, it's, you may not like it, you may not love it, you may like it. I mean, whatever it is. I mean, buybacks benefit shareholders, insiders. That's how they liquidate their shares. But it provides a lot of net buying for the market. So it's just, with that window now open through the end of the year, there's roughly $5 billion a day in buybacks that are going to support asset prices. So, and again, this isn't your small cap, mid cap companies. They don't have the capital to do this to any great degree. I mean, you don't hear about Trex announcing, a $50 billion stock buyback. They just don't have the capital for it. It's Apple, Microsoft, Walmart, Costco, or whatever, right? It's these big mega cap companies with a few $100 billion on their balance sheet, and they have the capital to buy back significant shares. And that's why I wrote that article we discussed last week, are FANG stocks dead yet? Because there's a lot of reasons why these big mega cap companies like Apple, Microsoft, and others, that's money. You may hate them, you may love them. I mean, you may hate Facebook, Meta, whatever you want to call them, but because of where they're anchored in the indexes and because they're in so many different ETFs, they're just going to keep getting money flow. And you've got to be aware of that.
Yep, and that's back to our Bill Fleckenstein's giant mindless robot, that as long as the capital inflows are positive and we have all these, algorithmic ETFs out there buying according to, their mathematical equations, it's just math. That's the problem with this, right? Is you're fighting math, right? With these guys. No matter how frustrated you get, the math is not on your side as long as the capital inflows are positive and substantial. I guess the only other thing to say on buybacks is that I imagine there is an increasing attrition of companies able to do buybacks, because back in the salad days of, January, you could borrow at super cheap rates and buy back, retire shares that were costing you more than the debt is. But now that debt has become so much more expensive, a lot of companies can't do that anymore, I imagine.
Well, absolutely. And I'm just kind of wondering what day, when do we get to the day that Apple becomes private because they bought all their shares back? So, there is an end game to this. I just haven't figured out exactly, where it is. It's probably not my lifetime, but, there's going to be a problem, down the road with share buybacks. And, it's the least best use of capital for companies. And I love these arguments people put out about share buybacks. So like, share buybacks, return of capital shareholders. A, no, it's not. We discussed that before. But B, it's a one-time use of capital, right? I buy back shares today. That capital is now gone. I've used it, and it goes away. Versus using that for doing a merger or an acquisition, or expanding my production base, or hiring employees, or something that generates me long-term returns. In other words, investing that capital for future growth. I'm using it for these one-time benefits just to help boost my EPS. And that's a very poor use of capital long-term. And again, I think at some point this comes back to haunt companies. And we saw this during 2020, Boeing is a good example, had spent 5 years of burning capital doing buybacks. And when they got into trouble, they had no capital and had to go run to the government for a bailout. So
right.
This is the end game of all this.
Although, I just put it this way, but like, were they wrong? Right? They're like, hey, we can enrich ourselves, and then when it all goes to hell, the government's going to bail us out here. I mean, that is the system as it's being played and gamed right now, which is super frustrating because it worked out for Boeing, right? It tends to work out for like the airline industry. They're famous for that.
Remind me for our rant of the day to talk about stakeholder capitalism.
Okay. I'm writing it down right now.
Yeah.
I have another topic, but we'll make time to squeeze it in.
Or at any point in the conversation today, we can talk about the value of stakeholder capitalism.
Okay, will do. And what also infuriates me about buybacks, and there's so many, we've already ranted about them in the past, so I'm not trying to get that rant started back up, but the justification that management uses when it does the buyback, they say is, we can't find a better use of this capital than this investment here, right?
Which tells you the problem.
Yeah. But what that says is every company out there, except potentially one, is wrong in that statement. Because if buying Apple stock is the best investment, well, then every company should be buying stock in Apple with that extra money, right? I mean, so they're saying, I've looked at the whole world. I've looked at, like you said, Lance, all the other things we could do internally with this money. And the number one thing at the top of the list is we are going to buy back our own shares, right? And of course, we've talked about in the past how that hugely benefits the insiders and the top shareholders at the expense of everybody else, and oftentimes hollows out the balance sheet and yada, 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 yada. So it's terrible, but it does make me laugh with sort of a gallows humor that with all these people making that statement, by definition, they're all wrong unless one of them truly is making the right decision. And I even doubt that.
Well, no, I mean, to your point though, for them, it is the best use of cash, right? Because it just makes, I've got these shares inside the company and I want to convert those to cash. So I sell them to the company. It's a great deal. And so it makes me wealthy. That is perfectly a best use of capital. Why on earth would I want to go hire employees? I got to put up with all their nonsense and they want days off. I got to pay them benefits and all that crap. And go buy another company. Really? Now I got more work to do and it's a long payoff. It's kind of like we talked about the other day with ExxonMobil. Why won't they build a refinery? No incentive to do it, right? I mean, so, the problem is that we've developed these and this is why buybacks were illegal until 1990, because it's a form of market manipulation. But, it's a very perverse incentive to do buybacks, because it takes away, and this is kind of FTX, right? We talked a little bit about FTX last week. And but what we've kind of moved to in society is doing what's best for the insiders of the company rather than what's really best for the shareholders.
Well, exactly.
And this is and again, it's this perverse incentive that was started under Bill Clinton when he capped salaries for executives, and which spurred this whole development of stock options and everything else inside the company. But now instead of giving incentive to the corporate executives to grow the business where they'll make more money, this is now the fastest way and the easiest way to become very wealthy inside of a company.
Right. The incentive has more or less become what can you get away with versus what's in the best interests. Right. So totally agree. I'm sure everybody watching is nodding. And folks, we could easily keep ranting on this, but we've done it before. And we've got other stuff to talk about this time around. So I'm going to have to pull the discussion back. Real quick before we move on to your piece, you mentioned kind of in your recap for the week, you gave brief mention to what we saw from some of the retail companies. And it was interesting. We saw really good results from folks like Walmart, right? And we saw really horrible results from folks like Target, right? And I'm sure in there is, there's definitely things that we can take from, hey, is this supportive of recession or not? I'm sure there's, some management of the companies involved, management differences. But one way I heard it put recently that at least resonates with me is Walmart largely sells stuff you have to have. And Target sells more and some overlap obviously, but more, stuff that you don't absolutely have to have. And so what we're seeing is the collapse of the Maslow's pyramid of hierarchy of needs, right? Just the top of the pyramid's coming off first, right? And not that, Target sells gold-plated, toothbrushes and stuff. I mean, it sells stuff you need. It's very practical, but it's not quite as essential as Walmart is. And so the thought is Walmart sales haven't fallen off yet because people they're going to do whatever it takes to just get the basics for living. But even just one step up the food chain here, or one step up the non-essential chain, we're seeing serious erosion of demand.
Yeah. Everything is going to migrate down to the lowest common denominator for the household, which if you just took a look at recent credit card statistics, huge jump in credit card debt again this month. So, it's just, we're continuing to see the consumer having to take on more debt. There's an interesting stat out. Don't quote me on the exact numbers. I'm in the ballpark, but if I'm off a little bit here, don't crucify me. But the New York Fed reported there's 555 million credit cards in the U.S. Now, what's interesting about that, there's only like 369 million people, and counting every woman, man, and child, baby, everybody else, which means there are more credit cards than we actually have the population. Which
Right.
That makes sense, right? Because everybody has a couple, right? 1, 2, 3, 5, 10, 20, but what we're seeing is more and more of these individuals taking out more credit card debt, applying for more credit lines, opening them up. But the banks are now going to start reaching the point to where they start kind of reaching saturations. Like, hey, Adam, I'm not going to give you any more credit. You're kind of, maxed out. So, it's worth keeping a watch on what's happening with retail sales. And again, you got to be careful with these retail sales numbers when they come out. Like 1.3% was the retail sales number this past week. Two big problems with that number. One is Halloween, right? So you had a bump for Halloween retail sales. Everybody's out buying candy and costumes, and Adam was buying his Ninja Turtle outfit. Then you also had all the stimulus checks, Raphael, in California.
I was going to make a Spider-Man villain joke, but go ahead.
But in California, you had all these. Did you get your stimulus check in California, Adam?
Yeah, somehow it missed my household, but
it did. Damn it! I don't know how that happens. but so you had all these stimulus checks, which made up a very big. Of course, everybody got these checks. They went out and spent it, so that all fed into retail sales. So you had this kind of abnormally big spike. But the important thing about the number was, always remember when you see these retail sales numbers, immediately the headlines are consumers are doing great. Retail sales up 1.3%. They're just buying all kinds of stuff. No, they're not buying more stuff. They're paying more for the same amount of stuff. Right. And that's inflation. And so you always got to remember this. And eventually that's going to feed through the system here. And so, there's a real risk here. We could see pretty weak retail sales numbers for the end of the year. But Walmart versus Target. I don't know if one, Target tends to be a bit more of a woke company, kind of like Disney, and those companies have really been getting hit hard. Disney got creamed. Walmart tends not to be. So, I don't know if that was feeding into some of the differentials in their sales. But the important thing about what Walmart said is they had a huge pop on earnings, but what spurred that was their better than expected outlook. Yeah, I got to be a little careful with that. Their previous outlook was for a decline of 12% in sales. They revised that to only a decline of 6% in sales. Mm-hmm. So they're still having less sales. It's just not as bad as they thought, and they got a 7% bump out of that. So, it wasn't. The earnings were better than expected, but again, you got to take that with a grain of salt because they're still not great. Right? We're still not talking about an acceleration in sales. We're not talking about stronger economic growth. We're still talking about declines in sales and earnings and outlook. It's just not as bad as expected. And rallying the markets on not as bad as expected isn't really what you want, right?
Yeah, that's not the platform you want to be running on to get everybody running behind you.
Yeah, it's like the doctor says, "Hey, we're only going to have to amputate your leg from the knee down rather than the hip." Right?
Yeah. I mean, I guess that's good news, but it's not a net good development. All right, so again, we're taking our time to get through this discussion here, because you keep raising such great points. Just as you're talking, I'm sort of reflecting back to previous generations in America, even before you're in my time, Lance. But we all remember back when credit cards were very new, and when you wanted something that you didn't have, you had to save for it, right? I mean, we had a national culture around savings, trying to live within our means, all that stuff, certainly nationally, but also at the household level. And they were back. I mean, there's still people around here, maybe some watching, who remember, the old layaway programs, right? When you wanted something at a store, you'd go in and say, boy, I'd really like to get that. Can I buy it? And they'd say, great, we have a layaway program. You make a, contribution as you can. And then once you've made enough, you can walk out of here with this thing, right? And of course,
but you didn't get it until you paid for it.
You didn't get it until you paid the full ticket price for it. Exactly. And now, of course, we have this whole, leveraged economy and this mindset amongst the consumer of, hey, these credit cards are a great asset because they let me get what I want now. Right. And of course, you and I know the rapacious math behind, the interest rates that these things charge. And not only to your earlier point that now what we're seeing as times are getting tougher is that people aren't yet quite downshifting their lifestyles, at least not too substantially yet. But what they are doing is shifting way more of how they're paying for it is on the plastic and on these revolving forms of credit. But there's also been this, explosion in recent years of the buy now, pay later movement. Have you seen this? Like when you go to Amazon or any, online company, you're going to buy something. They're like, okay, well, look, this is the price and you can buy it and put it on your credit card now, or you can use one of these buy now, pay later services. And we're just going to charge you X amount for the next 8 months or 18 months or whatever for this random thing that you probably really don't need now. But we just make it so easy for people to go into hock here. And as a consumer, we're kind of still holding on to the mindset that, hey, if I can get it, anything that helps me get it today is good, right? Not realizing that we're basically, damning ourselves to a lifetime of debt servitude, trying to pay all this stuff back.
Right. Well, it's interesting. I discuss this on our daily radio show, that we do in the mornings. I went through a whole big rant a few months ago talking about these whole buy now, pay laters, because a lot of those programs are now starting to come apart because guess what? People can't afford to pay for it.
They're totally unsustainable at the household level.
Yeah, and that is like surprise. That how did anybody ever think that was going to be a problem? It's like all these micro loans and stuff that people invest in. It's like, oh, you can invest in micro loans and invest. If somebody's coming to you and say, hey, can I borrow $50 to go and pay my rent? I mean, why do you want to loan this guy money? If he can't pay his rent, how's he going to pay you back? Right.
Right. And let me just interrupt to introduce a concept that we can talk about later on at some point, because it does deserve a real exploration. But there's something called adverse selection, right? Which is a problem in business where you create a business model that attracts the exact wrong type of person that you want. And this is a total adverse selection model, which is let's take the least creditworthy people, right? And let's give them credit.
Yeah, and again, not surprising, this isn't going to work out well. And I was warning people back then. I was like, do not invest in these companies. It's just leave those things alone, because it's going to be a very bad outcome. But this was a point in time where lots of liquidity in the market. When you have too much money chasing too few assets, you get these these anomalous on companies. FTX, right? I mean, just even hedge funds weren't doing due diligence. These people that are supposed to be the smartest people in the room, BlackRock, Sequoia, Tiger Global, these are supposed to be the smartest guys in the room, teams of people, and they were doing very little investigation. They were not getting valid financials. The auditor that is now taking over for FTX is the guy that audited Enron, which was here in Houston. And so I'm very familiar with what happened with Enron during the early 2000s. And he even said, this is worse than Enron.
Well, actually what he said is it's the worst he's ever seen.
Yeah. Which it's worse since Enron, because that was the worst he had ever seen, but yeah, no, it's absolutely right. I mean, just the lack of controls in this, and how did, the smartest guys in the room missed that? Well, they were greedy. They had all this, and this is the problem. We have all this liquidity coming in, these hedge funds have to get it placed. Right now, hedge funds and venture capital firms have over $500 billion of capital they have to invest. If they don't invest it within a certain time frame, they have to give it back. Well, I don't want to give it back because I can't charge any fees on it. So how do I make money? I got to get it invested. So when you have environments where a good example of this is, I don't know if you heard about this, the guy that was the CEO of Peloton. You know what he's doing now? Have you heard this story?
No, I'm guessing maybe he's like a barista.
I mean, you're not too far away. So the CEO of Peloton has resigned from Peloton after a spectacular crash in that company. Of course, he overestimated demand. No kidding. There's only so many people that will buy a bike for a coat rack. And then there's a few people like Adam that will buy it and actually use it. So, there's a limited number that's going to run out. You're going to run out of that number very quick. I used to be in the fitness business for a long time. And so, the way a gym stays in business is you just keep selling memberships because people buy memberships and they don't use them. And this is why you can't pay cash for a membership or write a check for all you youngsters, back in the day, we wrote pieces of paper that were a check. So I know you haven't seen one of those before. It was actually funny because the guy asked me the other day, he says, "Can you write me a check?" I was like, "Who has checks anymore?" But that's why gyms won't, the only way you can pay for a gym membership is pay for it on a credit card. Why? Because every gym knows, and when I built gyms, this is what we knew. I'm going to set you up on this automatic bill. Every month I'm going to bill you. You're going to come for the first month. I'm never going to see you again.
Right.
So I'm going to sell your membership to somebody else, and you're still going to be paying. And it's a cash cow machine. It's a wonderful business if you can get them up and running because it just prints money. And
it's just built on human frailty.
Exactly.
We commit and then we don't follow through. Yeah.
Exactly.
And then we're too lazy to go through our statements to unsubscribe. Yeah.
Exactly right. So that's a beautiful thing. Anyway, so the CEO of Peloton raised 25, and then this is my point, back to my point about too much money chasing too few assets. So here's a guy that just ran a company into the ground. Okay. He then goes to the same VCs that funded him at Peloton and raised $25 million. Ask me what he's doing with $25 million. Selling rugs. He's selling rugs. He says, I'm going to tap into the $1 billion industry of everybody needs a rug in their house. You need a rug to put under your Peloton, right? So he's now selling rugs in 5 different colors. And somebody gave him $25 million to build a rug business. And I'm not saying the rug business is bad, right? I'm not saying that, but all I know is every time I see a rug store, they've always got going out of business on the front and, come in and buy our Oriental rugs, hand-stitched Oriental rugs today for 50% off, going out of business. That's the one thing I know about the rug.
They last. That's up forever. Yeah.
Yeah. So anyway, but this is my point: is too much money chasing too few assets that leads to these perverse incentives of these hedge funds to not do due diligence and just saying, "Oh yeah, that's a shiny car. It looks great," and they plowed money into FTX thinking that it was going to be the next greatest thing since sliced bread, and you pay the cost for that. But again, the lack of due diligence of what people are doing. That's what occurs when you start just throwing monetary policy
money in the system.
Yeah.
And this is why you and I tend to always kind of bring it back to the Federal Reserve, central banks, monetary policy, plus bad fiscal policy, because that really does set the stage for almost all of this. And to your good points there, Lance. So I had a phenomenal interview with Jim Bianco earlier this week, really just deconstructing everything that we know to date about the FTX scandal. And folks, if you haven't watched it, you should go watch it after this one. I'll put up a link to it right here. But what Dave was saying is specifically about the guys at Sequoia, who they are the top of the Sand Hill Road, Silicon Valley VC community. These are the smartest guys in the room, supposed to be. And he said, here's the mentality is there's, to your point, there's so much money sloshing around and so much easy money being made. They said, if you're a partner at Sequoia and, Sam Bankman-Fried comes in and says, hey, I want you to invest in my fast growing crypto thing. And you say no. And then he's like 3 or 6 months later, because that's the time frame these things run, it's worth like 3 to 5 times more than it was when he walked in the door. He's like, you're very quickly an ex-partner at Sequoia Capital. And so really your incentive is to say yes to kind of anything that looks like it might do something. And he said part of what this is sort of revealing is the tide is beginning to recede here. You know, the whole Warren Buffett, you find out who's swimming naked. He says it's really kind of revealing that this this reverence for the smartest guys in the room in a lot of these VC or private equity, you know, firms. What it's really just revealing is they had just had a spray and pray strategy. And they were like, look, we're going to make like 100 investments. We know that like 95 of them are all going to be duds, but 5 of them are going to make us ridiculously wealthy, right? And so that's kind of the mentality there, which is they're just like they're incented to say, sure, we'll fund you. And to your point, you know, due diligence, yeah, we'll get somebody on that at some point in time.
I know, and it's just, but again, this is how frauds pop up. This is how Bernie Madoff popped up. You know, when Bernie Madoff was at the peak of it, you know, he was just printing 12% returns, and we now know that those were all fictitious. And you know what got Bernie Madoff was in 2008, the market's down 50%, and he printed a 12% return. He says, "Hey, I made 12% of my money." Mm-hmm. Right? Everybody's like, "Hey, wait a second now," because we know what you're invested in. And that doesn't seem right.
That's just not mathematically possible. Yeah.
You know, and this is the thing that always fascinates me. So Alan Stanford was, you know, right there on the heels of Bernie Madoff. He was here in Houston. And what both these guys did wrong is they had the opportunity, right? So what all Bernie Madoff had to do was in 2008 say, you know, he'd taken all this money fraudulently, $50 billion he'd taken in. All he had to say was, man, I invested all that money into subprime mortgages. They all went to zero. I'm so sorry. I lost your money. Nobody would ever question it.
Right.
Right. And but he got greedy and believed his own magic and said, oh yeah, I'm printing money. I can do this. And that's what caught Alan Stanford as well. Same thing. These kind of CDs that he was putting out. It's like, hey, wait a second. You can't do that in this environment. And that's what eventually caught him. So, you know, this is, you know, what we see happen over and over again. It was funny. When I was on with Charles Payne, just before me was Senator Warren Davidson talking about FTX. And he's like, yeah, one thing that we're working on is a bill because, you know, we need to align ourselves with the SEC so that they're catching these, you know, they should have caught this FTX fraud, you know, kind of in advance. And I laughed because SEC has never caught anything in advance of any size. Now they go after you'll hear them every now and then. It's like, oh, we caught this Ponzi scheme or this fraud in, you know, Wish Wash, Oklahoma, this $5 million investor. They go after individual advisors all the time, right? And they get those guys, these little small, you know, $10 million, $20 million deals. They miss regularly these $50 billion deals. They miss the Enrons. They miss, you know, the WorldComs. And I'm throwing out names. People are going, who the hell is he talking about? I know, way back in the day. You have to go back to 1999, 2000, but Enron, WorldCom, Global Crossing, they missed all those. They missed Bernie Madoff. They missed Alan Stanford. Why? Because, you know, a lot of these firms were aligned with Goldman Sachs, Bear Stearns, and those guys have, I hate to say it, but basically the SEC is not incented to go after the big guys because there's a revolving door between Wall Street and the SEC. So I don't want to go ping Goldman Sachs because I want to go work for Goldman Sachs when I leave my job. And so, you know, if you want to fix the regulatory, or Mr. Davidson, if you watch this interview, if you really want to fix the problem, the first thing you have to do is you have to close the revolving door at the SEC. If you want to come work for the SEC, love to have you. You cannot go work for anybody else for 10 years after you leave the SEC.
Right. Can I just expand that to all of Capitol Hill?
Pretty much. Absolutely. But this is the problem because this is where they go next, right? They all go to Wall Street. They all get on the boards of Goldman Sachs or
Citadel,
Citadel, whatever. And they get paid lavish funds. Look, when we were investigating high-speed trading, right? This was one of the big things in the high-speed trading investigation. We were having this big investigation. Where finally, man, everybody's excited. Finally, we're going to crack down on these high-speed traders. We're going to do this. Right in the middle of the investigation, the lady that was the lead investigator left and went to work for the high-speed trader they were investigating. So
I know, isn't that just,
right there.
Yeah, it's rampant. And just to make folks' blood boil even more, with this whole FTX scandal, so who was the SEC partnering with to determine how to regulate crypto firms with
that would be
crypto regulation policy?
That would be Sam Bankman-Fried for 200.
Exactly. So Gary Gensler was working very, very closely with Sam Bankman-Fried on this. And then, so that's awful in and of itself.
And they still didn't catch the fraud. They were working with him and didn't catch the fraud.
That's what I'm saying. And then, and I don't know, how much these people were talking at the time, but when you look at who ran the department at MIT that Gary Gensler was in when he was a teacher at MIT, teaching about cryptos, by the way. But the head of that department, forget his first name, last name Ellison. Well, his daughter is the CEO of Alameda Research, which was what caused initially the blow up at FTX. And of course, she had been dating Sam Bankman-Fried somewhere in there. I mean, it could not have been more enmeshed. And yet, to your point, Lance, the SEC didn't catch whiff of any of it.
Well, and again, and look, let's just be honest. They've never caught any of these big. They do a good job of catching little guys because that's easy,
right? And it makes headlines. Yeah, you put Martha Stewart in jail, and okay.
Well, no, she was even big. I mean, I'm talking about the majority of the people they get are little, small, registered independent advisors just doing their job. You never hear them, nab some guy at Goldman Sachs, right? That never happens until after the fact. And then when something blows up, well, now we've got to have all new regulations, right? So we've got to pass Sarbanes-Oxley to solve Enron. We got to pass Dodd-Frank to solve Bernie Madoff and the mortgage crisis. We got to do the Investment Act of 1940. It's just after every single time that we have some type of major crisis, then we regulate it so that that never happens again. And then what Wall Street does is go, well, wait a second, here's a loophole. Let's go do this over here. Right.
And then you close that door, so let's just go look at all the other doors.
Exactly.
And windows. Yeah,
exactly.
Totally. All right, look, I'm going to keep.
Then we don't catch them. So keep going. Sorry.
Well, look, we just have so much to get through. I still haven't gotten to your piece here. So why don't we?
There's nothing there. It's not really that good. So
yeah, I know there's a lot of great charts here. So I want to dial through these because they here's the point I'm going to work up to here, which is we are beginning to see, I think, a shift in terms of kind of the harsh reality that recessions enforce in the world. So we've had this long, prolonged summer, if you will, these salad days in the markets where the returns were easy, right? The borrowing was easy. It was easy to get away with whatever you wanted to get away with. It was easy to get a job and easy to keep a job that didn't really, potentially create a lot of value for the company or have that much demand on your schedule and whatnot. And there's a bunch of things we're going to talk through here in just a moment about how I think those are going to get peeled away real fast, right? Reason I'm bringing this back up, just to remind everybody, is this is sort of a, hey, there are some reasons to maybe begin to get optimistic, but maybe not so fast, because if we look at the data, there's still some really concerning things here. So let me just talk to a couple of charts I'll throw up here, and then you can opine any way you like. First, you put up a chart here by Jesse Felder, which was showing the cyclicals to defensive ratio, which there's a pretty big gap between them right now, between the ratio I guess between manufacturing and the stock market, right? So your point is like, hey, this signals that cyclicals like the tech and consumer discretionary sectors could have a great deal of pain still in front of them.
And the point that Jesse was making, it was a really good chart that he put out. And the thing is that there's a lot of these charts. I do a lot of them as well. If you take a look at earnings versus the Philly Fed Index, or you take a look at, the year-over-year rate of change in the S&P 500 versus the manufacturing composites, all of these suggest that, we've still got a ways to go in the market to the downside. So we haven't worked through those type of analysis. And that's what the chart that Jesse Felder put together is also suggesting, is that we've got more work to do in order to align valuations with economic growth. And this is something I touched on earlier when we were talking. is that, there's a lot of people right now, every time that we get a little whiff of activity, and potentially, as we said, every time somebody talks about, oh my gosh, the Fed's going to pivot, we start running stock prices up. And, really, we've had a lot of volatility this year. The market hasn't gone anywhere since June. I mean, we just kind of been trading sideways, up and down, up and down, up. We've had these big runs, big declines, big runs, big declines, and we haven't really gone much of anywhere, but it's just wearing investors out. But the problem is with the price staying where it is roughly, let's just say that prices stay right at 4,000 or 3,500. You just pick a number. It doesn't matter. But if you say, okay, if prices are going to stay at 3,500 and earnings per share right now are $200 a share, if earnings come down and the prices don't move, valuations go up because it's the price to earnings valuation, right? So, in order for valuations to decline, and we're still running at 20, 22 times earnings based on Shiller's CAPE ratio, we're still running at high valuations, based on historic measures of just about any type of valuation measure you want to look at. Yes, they've come down some, but if earnings do have to decline in order, okay, let me back that up. If you believe, right? So here's the question: what do you believe? If you believe that the economy is going to slow down more because of the Fed rate hikes, which is exactly what the Fed wants to have happen, right? They've already talked about, hey, we're going to have to cause some pain here economically to get rid of inflation. So that means we're going to have to slow economic growth down. Well, if economic growth slows down, economic activity is where earnings come from. Earnings just don't magically show up, right? It's what you and I buy at Walmart that translates to earnings. So if the economy slows down, if economic activity slows down, earnings have to come down. And in order for valuations to reflect slower economic growth and slower earnings, and this is the chart that Jesse put together and that we built off of for that article, is that prices have to come down. And so that would suggest a much deeper recession than what the Fed is hoping for. When the Fed hopes like, hey, we're hoping to have a shallow recession or a soft landing. Even Jerome Powell has now admitted that window is narrowing for a soft landing.
Yeah. All right. So you just made a really good argument that, if earnings come down, then prices have to come down. I want to just pull up a couple of charts real quick from your article that give really good data suggesting why earnings have to come down. So first here, there's a chart from the composite economic index that is signaling that earnings will decline further as the economy slows. All right. So we've got this chart, and basically it's now reverted back to the zero line, and all the momentum looks like it's going to take it, down into negative territory here. I'm going to mention. Okay, comment that one first.
Yeah, no, I just want to explain that chart because that's a composite that we built. So the economic composite indicator has 100 different data points in it of the economy, and it covers everything from both leading to lagging, service to manufacturing. So, when you take a look at the manufacturing indexes, people go, well, manufacturing is only 20% of the economy. It doesn't matter that much anymore. It matters. But services, that's what matters now. So this economic composite has all the Fed regional manufacturing indexes in it, has the leading economic index, has the OECD economic indexes, because those OECD economic indexes have a very high correlation to U.S. economic activity, plus the NFIB Small Business Investment Index, as well as the Chicago Fed and National Activity Index, the Chicago PMI, the ISM and Composite, which is a combination of both the services and the manufacturing of ISM. All that is fed into this index, and it has a very high correlation with economic growth over time. It also has a very high correlation with the 6-month rate of change of the leading economic index. So in other words, what that index tells you, it's a very broad measure of economic activity, and it's telling you that the economy is on the verge of a recession, although we're not there just yet. So I just want people to understand it's a very broad index.
All right, great. Which I think gives it even greater weight. And so the fact that the trajectory is heading down towards the negative bound now, we should pay heed to it. You've got two other charts here. I'm just going to mention, then I'll let you talk to them. One is the percent change of the S&P annual earnings. And we're seeing that the estimates for next year are still it's projecting growth over the coming quarters, and each quarter looks like it's going to be bigger than the one before,
Yep.
right? And then you compare that to the deviation of earnings above or below the long-term growth trend, and you're showing here again in the projection part of this chart that things are still going to hang in there pretty well, right? So basically, I look at those three charts and I say, okay, if we look at the two charts I just mentioned, things don't look so bad. But then if I look at your composite chart that you had, it's like, wait a minute, these really aren't agreeing with each other here. And my guess is that the rosy estimates are going to have to come down to map to reality as reality unfolds.
Yeah, let's talk about that one chart in particular, which is the deviation long-term growth trend. So if you go back in history, and I have earnings data going back to 1930, and you map this out, right? You look at the earnings growth over time, and I have to give credit where credit due. This was John Hussman's original work, and I adapted it. But when you take a look at earnings over time, they grow at 6%. Historically, the exponential growth trend line of earnings has been 6% over history, and that's peak to peak. So in other words, at the peak of an economic expansion, and then to the peak of the next economic expansion, that growth rate is about 6%. The troughs run at about 5% exponentially, trough to trough. So if you take a look at that chart, what it's showing you is the deviation from the exponential growth trend line over time. And the current estimates are above are so deviated from that long-term growth trend. Historically, earnings always revert to or beyond that exponential growth trend, which right now runs about $170 a share versus estimates that are at $211. So, historically, if you get in a recession, earnings are going to contract at least to that growth trend, if not below it, because if earnings don't contract, capitalism is broken, because earnings are the most mean reverting series kind of on record. So, if they're not reverting, there's something else going on, i.e., somebody's pumping the economy full of money.
Right. Yeah. Distortion, deformation, or maybe just accounting fraud at the end of the day. All right. Look, well, so there's lots of other great charts in your piece. I just want to read the concluding two paragraphs here, or two sentences. In other words, fair market for the market. Sorry. In other words, fair value for the market could still be substantially lower. A quote, hard landing will likely reveal how much lower that could be. So you did a good job at the beginning of this video, kind of given the bull case for what we could see over the near term here. But I think, this is a good counterbalance to that, which is, hey, there's still a pretty compelling bearish argument to be made here. And if you're going to go bullish, you really better at least have some contingency in place for these bearish arguments here.
Look, I get a lot of grief on when I do stuff like this, because like I read an article, it's like I say something bullish at the beginning or the end or vice versa. And it's like, well, you have to pick a side. It's like, no, I don't have to pick a side, because that's not investing. We talk a lot about confirmation bias. And when you're investing and investing capital, the most important thing to do is to evaluate both sides of the argument and then try to assign some probabilities as to which side of the argument is most likely going to be correct. As we talked about before, there's a possibility we could have a soft landing. There's a possibility that the economy just could continue to grow. There's a possibility that earnings don't correct. There's a lot of possibilities of things that could happen. They're not probable. They've never happened before in history when the Fed's hiking at the most aggressive rate in history, but there's always possibilities. And so it's important as an investor to evaluate those possibilities and apply some analysis to your portfolio and say, if that possibility occurs, am I prepared for that? Or am I all bet on this one side of an outcome that if this possibility occurs, I really get hurt? That's the thing that we want to try to avoid.
Yeah. And just to use another analogy, your job here, Lance, is the guy who is, at the end of the day, managing client capital, but also here on this channel, trying to educate people, is to try to help them understand where the puck is headed. Yeah. But as we talk about, it's all about probabilities, right? So even if you can see where the puck is headed, you have to know where all the other guys in the other team are to say, hey, a defender on the other team could come and actually take the puck in a new trajectory, right? And so I've got to be positioned to go where the puck's going, but ready to react if a surprise, a probable surprise happens here, right? And you're nodding as I'm saying this.
No, that's a great analogy, and I use that Wayne Gretzky, quote all the time, because it's very apropos to investing, and you're trying to guess, where things are going to occur. And back at the lows of June, we were buying tech stocks. Everybody hated them, but we were buying some tech stocks because like, hey, if this market rallies, that's where the money's going to go. And we just recently sold Nvidia and AMD. They had a huge run, and we reduced those positions. We still own them. We still like them long term, but we cut those positions in half, and we'll look for the next opportunity to buy them back.
Yeah, and that's why I think it's a good context for folks, where you will oftentimes come on here and we'll have a really bearish discussion perhaps, and then if they're subscribed to your Simple Visor alerts trades, they might see the next week that you buy a growth stock like an Nvidia, and may say, well, why is he doing that? Well, you're exactly explaining why right here. Okay. All right. So let's get on to the.
And by the way, the trades don't always work. It's full of fair disclosure. Normally, like some guy says, hey, I bought this stock, it went up 4,000%. Awesome. How many did you lose that went to zero? Right. Not every trade works out. We do our best, and we try to get more winners than losers. But that's part of investing, is that sometimes things don't work out as planned, and we just have to do something else.
That is true. And your partner, Mike Leibowitz, did a really good job of saying, hey, we bought some Meta before its last earnings announcement. And boy, did that not work out for us the way that we thought it would, right? And your guys' credit, you got out of it quickly, right? We had a thesis. It proved not to be right. Okay, we're done.
And we bought a very small percentage of the portfolio. And again, we talked about this before. When we start buying a position, we do very small percentage weightings in the portfolio, just in case, like a Meta, something doesn't work out. And then if it works out, then we'll add to that position over time. So, it's always about size. When we talk about risk management, it's about sizing your bets. I can bet on a pair of twos playing poker and win a hand, right? I just probably don't want to bet all in on a pair of twos. And, so I bet very small. If looks like I'm going to win, maybe I add to my bet a little bit. Maybe I can trick Adam and bluff Adam a bit, and he throws away a full house against a pair of twos. He's not the smartest player, but
I'd argue if that actually weren't true. I'm not very good at poker.
Yeah, but I can win a hand. It's possible, but I just don't want to bet a lot of money on it. So investing is the same way. Look, we're all speculators. Do not call yourself an investor. Do not think you're an investor. You are not an investor. You are a speculator. I'm a speculator. Adam's a speculator. We're all speculators, because all we're doing is buying pieces of paper at one price, and we're praying to God we can sell them at a higher price later. That's speculation in its purest form.
Yeah, I do, just because you brought that up, I do want to reiterate that you and I have already talked a lot on this channel in the past about our enthusiasm for the day, where we can be more investors than you can be in today's market, where still so much of the price action is being driven by policymakers, right? Because you're not doing the old-fashioned, okay, if I think a sector's good, who's the good player in the sector, and buying them. It's more, what do I think this old dude's going to do around a table? Because that's what's going to matter at the end of the day, right?
Exactly.
All right. So moving on to this next point here. Oh, sorry, two things real quick. One, Mike Leibowitz, I mentioned to folks recently that we've got Mike lined up to do a live presentation helping folks understand bonds and, relatively fundamental bond math. It's going to be live, so that after he gives the presentation, we can then actually do some live Q&A. We initially had that scheduled for this week. It has been moved to next week. I believe it's going to be next Tuesday. So keep an eye out for that, folks. We've had a lot of requests for this, and Michael was kind enough to say, sure, I'll come on and talk about bonds. So we've got that coming on. Also, when I was talking earlier, I made the comment, I see you nodding as I say this, Lance, and I do that because we're on Zoom, and so the camera's on me when I'm talking, and you can't see Lance nodding. So I'll mention that from time to time, but I've heard from people that that's part of their like Wealthion bingo card now. It's like whenever I say that, that's like a, okay, drink.
Funny.
So I'll try not to abuse that power. There are a few other ones like that people have brought up, which I think is pretty funny. We're becoming a meme here, Lance.
Yeah, well, no, I think it's great because they can't see me flipping you off either. So
yeah, exactly. And you notice I don't mention those ones. All right. So back to the point I was making earlier here, which is it is looking increasingly probable as we look at the data, and we've talked about this for weeks, Lance, is that months actually, is that we're going to have recession next year, and a real recession, meaning one that we actually feel and people can't try to push off of like, well, that's not the real definition of recession. It's going to be one where we're all like, yeah, we're in a bad recession at this point in time. And with that comes, I think, a changing of the guard, just in terms of the way the world has generally worked since the global financial crisis, where money has been so easy and the authorities have been so quick to intervene. And we've been able to sort of, if we get into a zone of discomfort, somebody is going to come rescue us, whether it's Jerome Powell, whether it's Congress, whether it's the HR department. We've all become accustomed to our like safe spaces, and the sense of entitlement, I'll say, for at least certain types of people, that the fact that they're getting a paycheck means they deserve it. And I'm not trying to be cruel here. What I'm really trying to do is just have someone who has lived through several down cycles in the economy, is whether you think that's all right or wrong, it doesn't matter. It all goes out the window during a recession. We've talked in the past, Lance, about how when I worked in Silicon Valley, seeing my commute change over the course of a month from like an hour and a half commute to a 15-minute commute, because so many jobs vaporized in such a quick period of time, right? And everything the companies have been telling you about how they value employees, and we talk about how layoffs are the last thing a company wants to do. So right up to the layoffs, they are telling you everything that they think you want to hear about how we're all in this together, and we need everybody to pull hard so that the company can make it through these tough times. And then you come in one day and like half the company gets, pig slips, right? And one reason why I'm mentioning this today is I put a comment out on Twitter. So Elon Musk fired half of Twitter, very visibly, like a week or so ago, right? Yep. And then today he made the remaining employees sign a pledge that basically says, we're going to demand extraordinary performance from you here. Like basically Twitter's in the fight of its life here, right? And if you don't want to be part of that, don't sign this, you'll get 3 months severance and there's the door, right? And right now it's unclear exactly what's going on. We don't have a lot of specific clarity into it, but the rumor mill is that tons of people are leaving, right? And what's so interesting to me is Twitter's still working, right? Now, I'm not saying it's not going to have rocky times ahead, but if you can lose, let's somewhat conservatively estimate here, 75% of your employees over the course of a couple of weeks, and the company kind of still visibly functions the way it always has, it does tend to sort of underscore that there were a lot of jobs there that weren't essential to daily operations. Right.
Yeah, you and I have talked about this before. It's like every time we have a government layoff, we always furlough 950,000 people that are called non-essential workers.
Right.
And we pay them anyway. But it's always interesting. I've unfortunately I've had to fire people in the past, and it sucks. I hate firing people. I hate hiring people. I hate people, but I'm teasing. But I hate firing people, right? Because it's gonna impact their lives. But they weren't a good performer, or they weren't a good fit, whatever the reason is, right? It's just part of doing business.
Or sometimes you literally can't afford them anymore. They were adding incremental value, but not essential value. Yeah,
exactly. And what happens with every business is that during the boom times, right, we hire a bunch of people. It's like, oh yeah, we need Joe and Bob and Frank and Marcy and Christina and all these other people. We need to do all these jobs. And then when things get tough, you start figuring out that really Bob and Christina are doing the same job that Frank could do, right? And so you start consolidating jobs and downsizing, those type of things. But it's always interesting because when you have to let somebody go, their initial reaction is always, well, you're never going to survive without me. And somehow the company always survives. And this is right now, there's RIP Twitter. It's kind of one of the trending hashtags on Twitter.
RIP, like RIP Twitter.
RIP Twitter. Yeah. And that's these employees leaving. It's like, oh, they're never going to survive without me. Look, I think that Twitter's going to probably have. So Elon Musk is a smart guy. He's very radical. He's very obnoxious, and I don't personally like him as a person, but you got to give him credit. I mean, he's built SpaceX and the solar company.
Even if you don't like the means, he said some amazing accomplishments.
Yeah, the guy's not stupid. And, he'll figure Twitter out, right? And hey, pay attention, people. If you can code, which is, I'm telling my son to do this right now, is like learn to code, or if you know how to code, here's an opportunity to go work at a company that's effectively on the ground floor. They've gone private and everybody's left. So if you've got some skills and some willingness to step in and work hard, here is a pathway you could really go build something for yourself inside this company and move up very quickly. And this is an opportunity to make a lot of money, from Twitter. So there's going to be some people that understand the value of hard work. And again, we've created this culture where it's like, oh, I don't want to work hard. People, I work 18 hours a day, every day, 7 days a week. I answer emails. You email me on a Sunday, you'll get an email back, right? Adam will tell you, I answer the phone, because I run a business and this is what business requires. And this is an opportunity, and he'll get this turned around. I think he'll do fine. He's got to flush all this out, but you're about to find out, what's essential and what's not inside this company. So it's probably a good process he's doing.
Well, so here's my point. And look, who knows? Maybe in a month, Twitter actually dies, and all the folks who were predicting it were right. It's possible. I don't know. I would actually bet that it's going to stick around. But here's my point, which is,
it depends on how many bots he gets rid of.
Yeah. Well, Elon seems to be, an Uber operator, and again, he's proven the doubters wrong a lot. But my bigger point is, look, I think we're going to have a lot more layoffs for all the reasons that you and I have talked about, both on this video, but many prior ones, about the type of recession that we're going into, right? So I think jobs are going to be shed, and they're getting shed increasingly in the tech industry for sure, right? Facebook just laid off 10%. I mean, almost every day we see another company that's laying people off here. So I think we have to prepare for that, as I've warned people a lot about. But here's the point I'm trying to get to, which is, if in 6 months Twitter is running smoothly, right? It's clear that it didn't die from this mass exodus, and they have been able to run the ship well, or at least well enough, with a fraction of the crew that was there. I predict you are going to see a ton of companies in tech, but probably spilling in other industries, who are going to say, whoa, wait a minute. This guy just got his employee costs down by over 50%, right? And he's still delivering value, right? Like, we need to challenge our assumptions about how many essential employees we have, right? So whatever downsizing they're already doing from, forced to do because of a recession, if Twitter is successful at this, I think it might show people, just like Musk did with the electric car, like, oh, you can actually make a cool looking electric car that drives really fast, right? Which nobody believed before. He may actually shift the goalposts for what essential means in corporate America, or at least in the tech side of things, which is very good from a corporate health standpoint, not so good in the near term from an employee standpoint, right? So that's the potential I just want to flag on here.
No, I think you're right, because even Mark Zuckerberg said that there's a lot of employees at Meta that probably shouldn't be there. Because what happened is, these companies, Google did the same thing, Amazon did the same thing. They create these groups, and they say, well, just go hire whoever you want, right? You're in charge of this group. And so there was just a lot of hiring that was done because people were just hiring everybody, and there was really no control over the hiring, so to speak. And so, and that was one thing that I was discussing on the radio show this past week, is that, we're seeing a lot of layoffs in the tech industry, but if you take a look at the employment increase in tech companies versus the rest of the economy, there's a huge gap. Yeah. So, and so a lot of these layoffs is just really kind of taking, they were just hiring hand over fist because of all this demand from work from home and everything else that was occurring during the pandemic. Now that people are going back to the office, that demand's kind of drying up, and they're just really kind of getting rid of those excess employees and kind of getting back down to, where they were previously. So, we haven't even gotten into the pace to where they're really cutting staff yet. They're just kind of getting rid of this excess hiring they did during the pandemic.
Right. And look, I know the tech industry isn't every other industry out there, but it is a bellwether, and it is generally a leading indicator. So, I'm
looking for layoffs in manufacturing, construction, industrials, banking. Right. When we start seeing,
we are beginning to see, right? Yeah, not to the extent of tech yet, but we are beginning to see some of that, right?
But when you see that pick up, now the economy is really starting to slow down.
Right. And we'll be tracking that every week on this program, folks. So don't worry, when it really begins to happen at scale, we'll be alerting you. But I do just want to tell this quick story, which is, so as folks may know, I worked for Yahoo in Silicon Valley for a long time, for almost 10 years. And my first day at Yahoo was bananas, because I joined Yahoo on the first day of its first layoffs. Sorry, on the day of its first layoffs in its history. Right. So I joined the company the moment it shifted from fantasy playground to, oh, I guess we got to run a business here. Right. And it was the weirdest experience in the world, showing up. Actually, the week before I showed up to work, my boss said, hey, we're having an all hands company meeting. Why don't you come and just see the company you're going to be joining? So I walked into the cafeteria, which is where they were having the meeting. And boy, Jerry and Dave Filo were up there on stage, as was Tim Kugel, who was the original CEO of Yahoo. And I was like, wow, this is amazing. I can't believe I'm going to work here. And then they shocked the entire room by saying, you know what, we're going to have to start laying some of you off. And they're crying. And Tim Kugel, TK, announces he's going to have to step down as CEO. And it was like, I thought I was joining this like birthday party, and I ended up at like a wake, right? So then when I showed up on my first day of work, I'm like, setting up my little cubicle with my phone and my stapler and stuff. And everybody around me is getting calls to go into the conference room and finding out they're losing their job. I mean, it was horrific to watch. It was like watching a pile up on the highway. And then of course I saw, what happened afterwards, which was everybody who had made their pile of money, started sending out those all company, hey, farewell, it's been great working here, but I'm just going to go count my millions now, see you guys. And the company had to figure out what was left. Okay, how do we create something sustainable out of this, right? So I saw it then. I saw it again when Silicon Valley slammed into the 08 crisis, and then I saw coming out of that with all of the QE and the stimulus and some of the innovations, how even more money than in the dot-com boom flowed back into tech. And all of that crazy perks and entitlements and free whatevers, I thought I had seen the end of it when I joined Yahoo, but that stuff returned with a vengeance on steroids once we got into the post-2010 era. And we've now we've seen all these. I'm basically just telling people I know what it's like, on the front lines there, in terms of how much of a fantasy working for companies like Google or Meta or Twitter has been. And so it's going to be a really rude awakening, in particular for those people who have gotten used to that. And there's a really funny Babylon Bee video that's been circulating around YouTube this week of a recent Twitter employee, now applying for their first job in the real world outside of Twitter, right? And they can't understand why there's not a meditation room everywhere, or there aren't morning mimosas, or, they see grease on somebody's hand and they have no idea what it is, right? So my point is look, this is all extremes. Again, the tech is an extreme example of this, but it is a bellwether of where everything is going, right? And so I do fear that a lot of people are going to lose their jobs and we're going to have a bad recession. But I fear that the recovery from this is not going to be a standard, okay, we went through the bust cycle, now we're going to go back to a boom cycle like we just went to before. I think potentially, especially if companies really understand now that they might be able to get by with a staff size that's substantially less than what they thought was critical, we may not see the type of job recovery from this downturn than we saw before. I'm not saying that that's going to happen, but I'm just saying the probability of that is beginning to grow, in my estimation.
Well, no, and I think if you go look at corporate profit margins in particular, so corporate profit margins, spurted up to the highest level on record when we shut down the economy, right? Because you had tons of capital coming in, right? All the stimulus checks, which created a lot of abnormal demand for goods and services. But we had shut down a big chunk of the economy, and everybody kind of got laid off in mass because we shut down, activity. So these companies all of a sudden have this big profit margin because of reduced staff, right? I mean, the highest cost of any business is labor. So when these profit margins start to come down, corporations have gotten very used to these very elevated profit margins. And I agree with you here. One of the byproducts from all this could be that companies become much more selective about who they hire, when they hire, and how they hire in order to maintain those more elevated profit margins. In other words, I become more selective about, who I hire. Adam, can you do these 5 jobs? And I'm going to pay you for one, but I need you to do these 5 jobs, rather than just paying 5 different people to kind of half-ass do jobs. And
Right.
that's going to be, I think that's going to be a big difference coming.
And let me interrupt you to let you react to this, which is what we've been hearing a lot about recently is, look, there's a labor shortage, right? I think a recession is going to take care of that in the short term. But people are saying, look, baby boomers are going to start retiring soon. So demographically, that's actually inflationary because you're going to have fewer workers per company out there going forward. And so, they're going to be able to demand higher wages, and that's going to be inflationary. And that may be true in certain cases in certain industries, but we may find, like you and I are talking about here, Lance, that companies don't need as many workers, or they may demand that the workers that are there do wear more hats, and that's just the way it's going to be going forward. And it may not create the inflationary wage pressure that some people are counting on.
It's interesting. I can't remember where I saw this. It was probably 2-3 weeks ago. You and I have talked about the problems with the job. So when you talk about job openings, Adam and I are talking about the JOLTS survey, which is the Job Opening Labor Turnover Survey. And that's produced by the BLS once a month. And we get this report. And it tells us how many job openings there are. And Adam and I have talked about before, there's a lot of double counting, triple counting of jobs in those job openings. As an example, a lot of restaurant owners will keep a job posted all the time because they have a lot of turnover in their business, right? Hostesses, waiters, they constantly leave jobs to go take a job somewhere at a different restaurant. So they just kind of leave that opening open all the time, even though they may not be actively hiring. But there's also some concerns about, they're possibly double counting job openings, the same job opening listed on multiple sites. So there's like, career.com and, all these other job sites. And so they've all got job listings. So it's potential. And the reason I'm saying this, there's a potential that we're getting an overstatement of all these job openings that have occurred since the pandemic shutdown. And there was a really interesting chart about this. It kind of brought this, focus back. It was produced by LinkedIn. LinkedIn, surveyed their own site, which is full of job postings and job hirings and all this. And they looked at the number of job openings they had on LinkedIn versus those getting hired on LinkedIn. And that number was drastically lower than what the Job Opening Labor Turnover Survey said, which is probably more realistic. And when you look at LinkedIn's data and kind of where the growth of job openings were relative to past historical trends, it seemed to be a lot more realistic than actually what's kind of coming out of the BLS right now. So, I still kind of gravitate to this idea that, yes, I know there's a lot of job openings according to JOLTS, but that data seems to be skewed because it's really accelerated so quickly relative to past historical trends. It's like all of a sudden we're just creating a mountain of job openings, but there's really not the economic demand for it. So, why are all these businesses, having hiring openings that they can't fill, when the economic demand is really starting to wane? And so I think the LinkedIn probably shows us that eventually that JOLT survey will catch up with reality.
Yeah, and I'll just even put my neck out and say, I think that those current JOLTS BLS numbers are highly suspect is the kindest way that I can put it, but I don't believe them. I know I'm supposed to be more unbiased, but I'm highly.
Well, I'm just using 2 different surveys that kind of tell us the same thing, and just I think we talked about employment. There's better ways to calculate employment. We just don't do it, right? So
right, and we don't, and there may be. I'm not saying for sure there is, but there may be reasons we don't. Right now it does serve the Fed in terms of its goal to be able to hike up as high as it wants to look at both lagging data and maybe lagging data that overemphasizes certain things. Yeah.
Sure.
All right. Speaking of which, so I want to get to the end of this because don't want to make it as long as we've been making the past couple of ones.
All right, let's wrap it up.
We're going to. The path we're going to take there is going to go through mentioning a couple bits of data here. I want to get to your rant. I'm going to put my topic. I'm going to punt that to the following week.
I'll tell you, we'll do your topic. You punt my topic for next week.
No, because mine needs more time than we're going to have. So we're going to end with yours. And I also want to ask you about your trades. I think you mentioned them briefly, but I'm not sure we got the comprehensive answer from you. So I want to give you a chance to do that.
Okay.
So real quick, just on this whole arc of what might happen with the jobs market contracting going forward. We generally do our sort of recession watch. Again, there just continues to be more and more data that comes in. I could go through a whole bunch of headlines here. There's just maybe two I want to put up here. One is that U.S. existing home sales are now crashing at their fastest pace since the Lehman crisis, right? So this is sales. This isn't prices yet, but sales precedes prices, right? Sales weakness precedes price weakness. So definitely the market is this, we used to debate this a few months ago, what was going to happen in housing. Now it's not up for debate anymore. The housing market is in correction now. It's just a question of how big and bad is the correction going to be. Another headline here that, or maybe not headline, but oil prices are now contracting pretty hard. And there's probably a lot of factors that are going into that. I don't want to necessarily say this conclusion is driving everything, but at some point, the global shakeup in trade, the flows of energy that are a big part of that, is going to get worked out. The worst of the kinks are going to get worked out. They're going to find more efficient ways to get the energy to where it's needed and whatnot. And so my question is what do we think is, or my question to you, Lance, is what do you think is going to win out here as we go into 2022? Is it going to be still the supply chain issues, or just the increased demand globally? And I maybe should walk that word back again. The essential need for oil in certain parts of the world right now, Europe being a really good example. Or do we think demand destruction just slowing the global economy enough that, yeah, maybe certain regions are going to demand more oil than they used to, but net around the world, the actual total global demand for oil is contracting, and therefore oil prices will start coming down again?
Well, since you started out by saying going into 2022, I'm predicting that oil prices will be higher for 2022.
Did I say that? Okay, good catch. Yeah.
But going into 2023, as we round the corner here, that is, look, it's all about global supply and demand ultimately. And, in 2021, we were talking about it was the time to buy energy because everybody hated energy stocks. Now, I have people emailing me, I'm 100% long energy. I'm never selling them. They're just going to the moon from here. Be careful with that. We've talked about the periodic table of returns before, and whatever's at the top for a year or two tends to fall right back to the bottom. So there's a lot of reasons why oil prices will decline next year. A recession is a really good reason why, because that's a contraction in demand. Oil prices will fall, supply will pick up. So, I think there's a really good, and we've been trimming our oil stocks over the last couple of months. We're about to trim them next week again. So again, we've had very nice, gains in these stocks, and we just keep trimming them. They keep growing up to be a bigger percentage of the portfolio. We trim them back, and we just keep harvesting those profits. But, at some point that tide is going to turn. And so if you take a look at what's the most hated right now, what does everybody hate? Everybody hates bonds, and they hate technology stocks. They hate discretionary stocks. At some point, those are likely going to be your biggest winners. So money's going to automatically rotate out of what was winning to go chase what wasn't winning. And so you got to remember, you may have this whole thesis, and this is why I warn people all the time, be careful with thesis. We can all day long, we can have this thesis of we're running out of oil and we're going to oil prices are going to go to $500 a barrel, pick your number. But ultimately, at the end of the day, this is about demand in the markets, supply and demand in the markets. And if there is an asset that's outperforming this asset, money will flow from this asset, regardless of your thesis, into these other assets that are performing better. And that will ultimately happen. And that'll happen when we start to see, potentially a recovery out of a recession or whatever it is. You're going to see this big rotation of flows, and you're going to want to make sure you're on the right side of that trade. So just, my whole point is always, be careful with these big, broad macroeconomic theses that say the dollar's going to zero, oil's going to the moon. Maybe it's possible. I'm not saying it's not possible, but things don't typically always work out that way. The dollar has done a really, big job of not going to zero this year, which was all the prediction last year. So,
Right.
you want to be careful with that. I'm not saying the dollar's not going to correct, because it is, but just it's probably not going to zero.
Yeah. All right. Well, good explanation. And look, I mean, personally, I feel like money flowing into the energy complex makes just a lot more sense to me than it did flowing into the FANG stocks, and will when it flows back into the FANG stocks again, because oil powers the global economy. It's an essential product. We need it, right? But that's why I sort of raised this question of hey, the mindset right now is, we've got these constrained, global supply chains, and oil price is going to be pegged high for the foreseeable future here. And there were calls not that long ago for $300 a barrel oil and all that type of stuff. And that still may come true. But as we look at the potential scope of the recession that the world is headed into, right? This is not going to happen in the US in a vacuum. If we're feeling it badly, chances are a lot of the world's going to be feeling it a lot worse than we are, right? That could have a material impact on global demand. And the fact that oil is now back out of the 90s, headed to the downside, is a sign that demand to a certain extent is ebbing enough for that price action to happen. And I want to just put up one chart here of yours, Lance. It's from the earlier piece of yours we were talking about. This shows how it basically shows the how consensus earnings for the S&P as a whole compares to the S&P if you take out the energy stocks. And you can see the energy stocks have really been supporting the earnings of the S&P, right? And why I bring this up is, if, I'm not saying it's going to happen, but if the energy companies start doing less well going forward because demand for oil is coming down and they begin to make less money, man, that could be another shoe to drop, the markets going forward from here.
The market would be off substantially if energy stocks weren't up 40% this year. Now, mind you, energy only made up 2% of the index going into this year. Now they're up to 4% of the index. But energy stocks are 40%, up this year versus everything else being negative. If energy stocks were tracking the market would be down a lot more than it is, right?
It would. Sorry to interrupt you, but if they're only 4% of the market, but they're driving that much of the market's earnings, that's amazing.
Yeah, it is. I mean, they're just printing capital right now. And, it's interesting. The UK has now gone after a windfall profit tax on energy companies, which is, just stupid. But, we'll probably see that here eventually as well. Stupidity does not fall far from the tree. Again, this is going to revert at some point, and these profit margins and these excess profits will revert, and they're going to become a drag on the overall index as well. So, it's just going to be a function of time. But again, you've got to be careful of rotating. And my whole point is just be careful. Again, what I said earlier, be careful of big macro theses. Markets turn, and they tend to do things that you don't expect them to do, because it's just really a chase of money flows.
Yeah. All right. Well, wise words. So trades, anything more than what you mentioned to us at the beginning of this discussion?
Just a couple. So this week, all we did was, this was on, let's see, what is today? The 18th. So the 14th, whatever day that was, Monday. Excuse me. So on Monday, we trimmed back on NVIDIA and AMD. I said that earlier. We also we had bought Goldman Sachs, at the bottom of the market back in about 4 or 5 weeks ago. That stock was up like 20% from the lows. So we reduced that. We also reduced a couple of other just kind of small positions, we're trying to get our total equity exposure in our portfolio down to around 35%. Going into next year. We're about 38% right now on exposure, so we've got a little bit more to go. And so what we're looking for here is a bit of a pullback. Potentially, we might add a little bit to a couple of stocks that we do like. Get this next kind of rally higher at the year end, cut exposure back to 35%, and then we'll kind of see what the market does next year.
Okay, and this just seems to me you're just living you're walking your talk here in terms of gardening, right? You're doing your portfolio gardening here with your position sizing.
Talked about doing listing. We sold Verizon earlier this year, replaced it with Comcast, which has done decently. But we like Verizon. We think fundamentally it's a great stock, 7% yield. Don't see any reason not to own it, and we'll buy it back. I just got to wait for my 30 days to go by so I can avoid the wash sell rule. But that we just did a couple of things this year that were tax loss sells because we've taken a lot of gains early this year. We came into this year with 70% exposure in a 60-40 model, and we cut that to 35% at the very beginning of this year. So we had a lot of gains that we need to offset going into year end.
All right, great. And just a reminder to folks, look at your portfolios. If there are positions that you've got sizable losses in, might not be a bad idea to maybe follow Lance's suit here and do a little bit of tax loss harvesting. You're raising your hand there? Yeah,
I just going to say is like this is a really important point. People tend not to want to sell things because they go, well, but it might come back. Just because you sell something doesn't mean you can't buy it back, right? Just sell it, take the tax loss. You can offset it against gains later, give you a little tax benefit, wait 30 days, and then buy the stock back, 31 days.
And you can even do what you're doing with Comcast there with Verizon, where you can jump into a near investment in those 30 days just to keep exposure to whatever upside you were hopeful for, right? And then shift back into the original instrument after your 30-day window's over.
Exactly. And if you're into ETFs, you don't even have to wait the 30 days. I got into a big argument with an accountant after one of our videos. And so basically, the IRS doesn't even look. If you have two identical, you could buy an S&P index fund from Vanguard, sell it at a loss, buy an S&P index fund from BlackRock, and the IRS considers that two totally different instruments. So you don't have to worry about tax loss sell when you're doing ETFs.
Wow. Okay. Although just to be super clear, if you own an ETF, sell it, buy it back within the 30-day window, that exact same ETF, that is a wash sale.
That is a wash sale, but you can buy two identical ETFs of different companies, and that is not a violation.
And it's not too similar for the SEC to carry.
And just a disclaimer, I am not an accountant, so if you disagree with my statement, I've had too many, I don't know for certain, but I've had a bunch of emails from accountants telling me that wash sale rules don't apply in ETFs with two different firms, even though they're the same ETF.
All right. So, well, two things on that. One is if this is something you guys haven't done before, obviously we recommend talking it through with your financial advisor to get their advice or talk to Lance's firm. And if you're going to do it, especially if it's at any real volume, maybe put in a call to your accountant and just give him a heads up and make sure that he's cool with your plan.
Yeah. And by the way, wash sales only apply to taxable accounts. It does not apply to Roth IRAs, anything like that, because you just simply pay income tax on that.
Yep. Got it. All righty. All right. So as we start to wrap things up here, Lance, I'm going to let you take us out here talking about stakeholder capital.
Yeah. Stakeholder capitalism. So this, and the reason I brought that up earlier is because of the whole FTX Sam Bankman-Fried thing. And there's a great video floating around of him talking about when he was like 29, first starting this whole FTX thing. He's like, I just want to give away money. I don't care about being rich. I just want to be a philanthropist. And corporations have the responsibility to do good for society. And that, in a nutshell, is the World Economic Forum's statement of what's called stakeholder capitalism. Now, stakeholder capitalism is not shareholders. Right. You got to be careful about this. Stakeholder capitalism is a spinoff of this whole ESG thing, which we have I've written articles on it. We've discussed the sham of ESG here numerous times. Which is a great way for these companies like BlackRock to charge you a whole bunch more money for nothing. You get the exact same product, just pay 4 times as much for it. But stakeholder capitalism is this creation by the World Economic Forum to put corporations in charge of your world. In other words, stakeholder capitalism says that corporations are responsible for cleaning up the environment, for making sure that you get the right type of information, that the corporations are responsible to make sure that the world is operating in a manner that is what would be considered beneficial to whom is the question. But it's putting corporations in charge of you. right? And this is the whole benefit of stakeholder capitalism, is that the corporations are now determining what's best for you and what the best outcome is. And this was the very premise around which Sam Bankman-Fried formed FTX, was this whole idea that I'm going to create this company. I don't care about being rich. Well, congratulations, you're not anymore. But I'm just going to give, and they had this whole interview with him where he could be giving away $500 million a year to charity starting over the next decade. And he's just going to give that away every year. And it sounds great. And it's like, and he's like, if you've ever heard him talk, he sounds like he's about 5 years old. He's like, yeah, I'm just, going to give all this money away and it's great. I don't care about being rich. But yet he was giving, living in a $40 million penthouse and giving away, houses to his employees and all kinds of stuff. Doesn't care about being rich, right? But this whole idea of stakeholder capitalism is that stepping stone to socialism. And this, and a lot of these movements that are being put out into the press and trying to make it sound appealing to you is that, oh, this will be better for you. It's not. And my daughter, the reason this came up is my daughter, she's a sophomore in high school. And she asked me, she says, Dad, I keep hearing people talk about even my teachers talking about stakeholder capitalism in my business class. And I'm like, I go, I get it. I understand what you want. I said, she goes, but it sounds like it would be better for everybody if this was the case, right? Everybody would be wealthier. And that's absolutely not the case. And I explained it to her this way. I said, imagine that you go into your classroom and your teacher says, on Friday, we're going to have an exam and it's going to account for 50% of your grade. And so you're going to go home, and she's very smart. So she goes home and she's going to study, and she's going to stay up all night studying, and she's going to do everything she needs to do to go make a good grade on this exam. Because if she doesn't make a good grade on the exam, I take away her car. That's the way it works. But all of her friends don't, right? They don't study. They just say, yeah, whatever, it's a test, right? So they don't study. So so the class comes in, they take the test, and 25% of the class makes A's, 75% of the class makes D's, or just call it 50-50 even, right? So 50 make A's, 50 make D's and F's. So the teacher says, you know what we're going to do? We're just going to average the grade. We're just going to average them. Everybody gets the same grade, so everybody gets a C, right? Sounds great. That's fair, right? That's what, everybody's equal. And this is the beautiful thing about being equal. We all get the same thing, right? Nobody's favored over anybody else. So she's like, well, she goes, that's not really fair. And I go, well, yeah, it's not fair. So let me ask you this question. The next week you go in, teacher says, guess what? We're going to have another test on Friday. It's going to count for the other 50% of your grade. We'll see you on Friday. Are you going to study for it? She's like, no. And I said, well, why not? She goes, well, if I study for it, I'm just going to get the same grade everybody else gets. And I go, here's the problem. Friday comes, you go take the test, you didn't study for it. So now you've got 50% of the kids making C's and the other 50% of the kids making F's. Now your grade's a D. And she's like, oh, that's terrible. And this is the problem with stakeholder capitalism and socialism, is that the way that the idea works, it sounds great, but it drives everybody to the lowest common denominator of individuals. So wages, economic prosperity, economic output, everything drops to the very lowest level because there's no incentive to produce. If there's no incentive for me to take risk because I don't get rewarded for it, there's no incentive to do it, which drives everything to the lowest common denominator, puts corporations in charge of everything, which is exactly what you don't want in a capitalist system. So calling it stakeholder capitalism makes it sound good, but it's socialism in a cloak.
Well, I think you just described the kind of devolution that socialism, at least to date, in every experiment we've seen it played out, naturally ends at. It also introduces the challenge that you're talking about there too, Lance, of sort of who watches the watchmen, right? The guys that are actually setting the rules and running it, right? You hope they're all going to be saints. History has shown they never are, FTX is just the latest example of that. Yeah, and it's super easy to talk about how much of a philanthropist you're going to be and give away up to $500 million a year when you're worth, at the time, I think he was worth over 30 billion, right? When he was saying that, right? So I mean, it's just, and living in mansions that, had been paid by FTX with client capital illegally. I mean, just So you have the whole watch the
just
watchman
little
issue.
things.
Yeah, and you know, just your example is kind of an extreme example, and people can kind of laugh about it and say, "Yeah, well, hopefully it'll never get that bad, Lance." But I want to tell a quick story as we conclude here. And man, this will be one of our shorter ones, which will be amazing. It's still over an hour and a half. But I was at a dinner about a year ago with fund managers. Friend of mine is high up in the banking system and lives in Europe, and brought a bunch of European fund managers here. And we're all getting to know each other and chatting around the table. And the topic of ESG came up. And well, really the topic of ESG came up, and then the topic of Tesla and how Tesla, that was back when Tesla was still setting crazy new highs every week. And I was talking about how just, look, I don't care what you think the potential business opportunity for Tesla is. I just can't see how you can justify the massive jump the stock had had over, you know, that recent year. And the guy said, well, look, I can explain to you a big part of it. He said, you know, I run a fund that's X billion dollars. I can't remember exactly how much it was. And he said, you know, over the past 2 years, I have been given ESG mandates where I have to invest a certain percent of my portfolio in ESG companies. And he says, I'll tell you, the problem is there just aren't that many of them. And so when it comes down to like my quarterly deadlines, and I still have this money I haven't spent, I've got to find A, companies to be able to put it in, and B, companies that the market cap is big enough that it can absorb what I have. And he's like, there really aren't that many other choices besides Tesla. So I find myself putting gobs of millions and tens of millions of dollars into Tesla quarter after quarter, not because I want to, but because I'm paid on whether I hit my ESG mandates or not. And I've got this artificial number I have to hit. And this is basically the only stock that can absorb the money I have, right? So you multiply his firm by a ton of others out there, yeah, and you just get this misallocation of capital, right? And you know, we talk about the evils of malinvestment and whatnot. And even something that's as noble sounding as, oh, we all want a cleaner environment, right? So we'll come up with some of these ESG goals. It starts wildly distorting the system, and nothing good, you know, ever comes of that. And I haven't looked at Tesla recently, but I'm absolutely certain the losses this guy has taken on Tesla over the past year have been gargantuan, just measured in millions.
Yeah, and it's interesting too, because I said back in 2021, I said that when the tide turns, and it will, and this is when nobody wanted to own energy stocks, right? Because they weren't ESG friendly. You know, I said, ESG is going to go out the window. People are going to buy what's going up in price. And you know, that's exactly what's happened. All those ESG funds have now had big outflows of capital, and energy funds have had big inflows of capital. So all these people that were virtue signaling, you know, their investments, oh, I want to invest in companies that are making the world a better place, are now all chasing energy companies because that's where money's being made. Same thing we saw back in the late 90s with sin stocks, right? Don't buy pornography, alcohol, cigarettes. When those became the best performing assets, everybody stuck their money back into those companies.
Right. Well, and as we close here, this is more or less the point I was making, you know, 15, 20 minutes ago or so in here, where I think we are entering an era where a lot of our, what do you want to call them, are more noble, but you know, are more noble intentions, whatever you call it, or the things that we want to have begin to get really limited by the harsh reality of just what we can afford. And you're going to see, I think, a continued shift of exactly what you're talking about there, Lance, which is, yes, we were all talking about social responsibility and ESG and all that type of stuff, but now we're more of an existential fight of like, we just have to stay afloat and alive. And so, yeah, kind of forget about a lot of what we were saying earlier. And it's you know, we're going to have fewer options, and the rules are going to be harder. And if you don't want to line up behind the rules, well, then there's the door, right? It's going to be just a very different world for a lot of people who have gotten lulled into this sense of like, we have a lot more opportunity and protections and everything that we had before. And I'm not saying I'm rooting for this, folks. I'm just saying I see that this is likely to be coming, at least to a certain degree. And the more we can position ourselves in front of this and not be victims to it is better. And I see you smiling and nodding as I'm saying this.
Well, just to sum this up real quick, we can close out on this as this comment. And this is what I've told people before, and I just want to reiterate this one point: is, you know, I get a lot of calls, you know, from this show and everything else that we do, and people go, well, you know, I think this is going to happen. right? I'm invested all in gold and silver, and that's all I own because I think the world's coming to an end. Whatever it is, right? Just the problem with those theses are, again, like I said earlier, is that things change, right? The world changes and these type of things. If you want to invest to make the world a better place, I am all for that. Just don't do it with your portfolio, because you buying Tesla does not make the world a better place. All you did was buy shares from Adam because he was selling them and you bought them. That exchange between shareholders, Tesla doesn't even know that those shares have been bought and sold. They're all what we call in street names. So we don't even know who owns those shares. We're just all trading them every day. But it makes no difference to the environment. Actually, it's worse for the environment because of the electricity used to trade those shares. Right? But so if you want to invest, to make the world a better place, go find somebody that's starting a business that is going to recycle something, or is going to create
carbon or
whatever. Yeah, but go invest in a private company. Go help him change the world. Be part of that, because that makes a difference. If you can't find that, go plant a tree, because that makes a difference to the economy or to the environment. But when it comes to your money, the only thing that matters is what's going up and what's going down. Don't get too wrapped up in big macro theses, because things change more often than not. You're going to be wrong about your macro thesis. I see it happen every single day with people. And been doing this for 35 years, and this is not different this time. This is the same as we saw in 99, same we saw in 2007, same thing we saw prior to 87. These times are not different. So focus on where money's being made, how you can do it with the least amount of risk, make a return on your investment. Don't worry about some virtue signaling thesis that you've got to follow. It has no bearing on your outcome. Your job as an investor is to make money for you and your family. Nothing else matters. Leave all that other stuff at the door. It's great dinner conversation. Have it over dinner. Go plant a tree for the environment, but make money with your money. That's the important thing.
All right, well, we're going to leave it there. And folks, next week we will address the, I think, more fun and uplifting topic of the importance of self-understanding. Last week, Lance, you may remember, I talked about how my daughter was about to go take that aptitudes test, the Johnson O'Connor aptitudes test. She did. We got the results. Super useful. I'll kind of summarize the experience for folks, and a few more things we'll talk about here. But I'm not. A lot of folks were interested that we were going to talk about it, and probably disappointing a few that we didn't get into it this week. But folks, we'll get into it next time. In the interim, this is the week before Thanksgiving. So folks, have a wonderful Thanksgiving yourselves directly. If you want some help with a financial advisor with all of the main issues, themes, and concerns that Lance and I mentioned in this whole video here, obviously you have a good one already, stick with them. But if you don't, or if you want a second opinion on one that does take all these things in consideration, maybe even Lance and his team at Real Investment Advisors themselves, just go to wealthion.com, fill out the short form there. You can have a free consultation with them. It doesn't cost you anything. There's no commitment to work with them. It's just a public service that they offer. And as usual, folks, if you enjoy these weekly market recaps and haven't gotten sick and tired of them so far this year, or in this long, still 100 hour and 45-minute one that we managed to squeak out today, I did try to keep it less. We're under last week's record level, but we're still going along still. So apologies, folks. But if you enjoy them and want to see more of them going forward, please do us a favor, support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And Lance, thanks so much for joining us again, buddy. Whatever happens in the next week, we'll be back here making sense of it for folks. Everybody else, thanks so much for watching.